Hi, everyone. Michael, Sinatra, Paul, Bran, AJ, how are you guys? Everyone doing okay? Yeah, it's Turnaround Tuesday. I don't know if there are any fades. How are you, Patrick?
Good morning, Dale.
Hi, how are you, Steve?
I'm good. How have you been?
Good. I'm hanging in there.
Good.
What do you think of gold here?
You tell me. I think you can see it staring at you, can't you?
Yeah, but I'm supposed to ask you guys questions. What do you
I
think?
this looks like a little
Flag?
triangular consolidation to me, a pennant. And I think the possibilities are for a continuation to the downside.
Okay. You have any levels where you would say, for example, think about adding to physical
Not yet.
or buying?
No. First of all, I don't intend to add to physical. I have the amount I wanted to have, so
Okay.
that's out of the question. Now, taking position in the markets, not yet.
Okay.
Next downside target is roughly at 1840, right?
Okay.
But I don't know if that's going to be enough.
Okay. So we're getting some follow through in the dollar.
Yes.
Okay. So maybe that, the rally in the dollar and the low in gold coincide with each other. Possibility.
Yeah. I mean, as I said, since I wrote it in the weekend analysis as well, I do expect to see follow through in this dollar move. And there is also the potential of seeing even more follow through if inflation data plays ball
next week.
Yeah.
Hey, good morning, guys. How's it going?
Good morning, Blake.
How you doing, Blake?
Good. Hey, you got to, you were just talking about Powell. Yesterday during the morning edge of the daily roundup, we were having this discussion, with the ForexAnalytix community, and we were talking about, expectations for the Fed to lower rates have to come down, because everybody's they were expecting like a 0.5% by the end of 2023. They had expectations for rates to come down, and then I'm like, well, after Friday's data, that had to have changed. Benedict in our chat room, I'm like, hey, he has a Bloomberg terminal because of where he works, and I'm like, pull up WERP and see where where expectations are at now. And I just read that expectations actually have come down quite substantially. So instead of the market expecting a full 0.5%, or excuse me, a 0.5% of cuts by the end of the year, it's more like one cut by the end of the year because of the strong jobs data that we had. And the reason why I point that out is because now we have Powell speaking today, right? There's a risk that, well, how should I say it? There's not so much a risk in Powell right now for the markets. The market has less risk with Powell walking it back, because he continues to say, hey, we're going to keep rates high, blah, 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 blah. The risk has actually subsided a little bit for the markets, because the markets have repriced.
I think, Blake, there is no real possibility for Powell to be dovish, not just because of the jobs data, but in general, he has refrained from doing so. And furthermore,
yeah, well, I mean, what is he going to change? But the markets, if he comes out and he's like continues to say the same thing that he said for every meeting and doesn't change a beat, the market is less likely to have a significant sell-off today if he's hawkish, because it's already repriced as of this weekend. Does that make sense?
Yeah, it does.
So
it does.
Anyway, I thought it was a really interesting. That's why yesterday I'm like, hey, we got to find out where rate expectations are going into the end of the year and how they've changed. And like I said, I was reading this morning that it has changed, and that makes sense to me, which means that if you are playing the dollar on the long side right now, you have to be a little bit more careful, because a hawkish message from Powell may not give you the results that you're expecting. I'm not saying that you should necessarily be short the dollar, but the dollar's moved quite a bit over the course of the last couple of days, right, Dale?
Unless of course he sounds more hawkish than the market expects.
What the hell is he going to say? Like, what is he going to say that he hasn't said already?
Sometimes it's not what you say, it's also the way or the confidence with which you pass the message. You know what I mean?
Larry Lindsay agrees with you, Steve. He said it was one of the worst Fed speeches he's ever heard, and it was more about not what he said, but his demeanor. And Larry Lindsay's a pretty smart guy.
Well, there you go.
He is, so I guess it's his demeanor. He was kind of nice, good cop. Last time, right? So
somewhat softer, let's say, in tone. Yes.
Yeah. So anyway, Paul, we have Joseph Yang here today. So what a perfect timing to ask him what his expectations are from Powell.
That's indeed great timing.
Yeah,
yes.
He's a fan of Powell's. Okay, so we'll hear what he thinks is going to happen. Last time we talked to him was at the Traders Summit conference in October. So be good to get an update from him.
And I have to say, I think it warrants to be a Powell fan at this moment. I know everybody will go, well, this whole transition, the transitory call a year and a half ago. But look, they've responded. The Fed's responded quite aggressively. We've raised rates like what's his name that always comes to the Trader Summit event.
Volcker.
No, that's always at the Trader Summit event that I end up interviewing. Steve, what's his name? Oh my gosh. From the Boom Doom.
Mark Faber.
Mark Faber. I mean, I don't hear much from him right now because he's like, Powell should have been more, aggressive in his, and he went balls to the wall aggressive as far as rate hikes go. And so it shut him up really quick. Amongst other people. So the Fed acted aggressively, and look, stocks didn't collapse.
No, surprising. The dollar rallied, but it didn't come out of its shoes and make every other currency completely collapse. I mean, the euro dipped below parity, but what's changed over the last 25 years? Nothing. So you like the way he's managing this fight?
I think he's redeemed himself. I really think he's redeemed himself. And
it depends on how you see it, Blake.
And Brand says stable US dollar is the Fed's business. Well, I think price stability is, he's done a pretty good job. I mean, go ahead, Steve. Tell me.
Sorry, I have to disagree with that completely, because you ask any central banker, although they're hypocrites in a big extent, but you ask any central banker, even Powell, until a couple of years ago, and ask them how do you judge the performance of a central bank if inflation shoots up to 10%, and every single one of them would tell you that's a magnificent failure.
Steve, I don't disagree with you, because we already pointed that out. I'm talking about from there until now.
But I mean,
months. That's the point.
I mean, it's like a surgeon cutting off the wrong organ, and then
snipped off your dick, but
making a magnificent effort to not lose the patient. You know what I mean?
Right.
If in the first place he didn't cut off the wrong organ.
But that's not the point I was trying to make, Steve. That's exactly not the point. The point I'm trying to make is I think they've redeemed themselves because they've acted quite aggressively and the market has not collapsed. And that, we have to
having to do with stock market performance. I couldn't agree more. The stock market has pulled back, but it has always remained in an orderly fashion.
Yeah,
right.
The VIX shows that.
What's that?
The VIX shows all last year that it was orderly because we never had a huge
exactly
spike.
Hey,
just look at copper, guys, before you grab the charts, Blake. Look at how it pulled back. You were talking about it looking weak way up here. And look, it pulled right back to the breakout here.
Well, you know, the thing about copper is, you know, I remember posting this in our chat room, and I'll show you. And one of our traders, DJ, he goes, man, that is a perfect breakout. And I'm going to show you right here. He's like, that's textbook. I'm thinking about, you know, I'll just show you. And DJ, I know you're probably listening in right now, but he probably remembers. I'm like, that looks textbook in copper. I'm like, I don't trust it, you know, and it, you know, it is slipped. Now we are at really critical support. And last night, we also had the RBA rate decision, and they mentioned that further rate hikes could be possible. And that's why if you look at the Aussie is actually holding up really well. I was short the Aussie overnight. I took a 20 pip loss in the or somewhere, something like that. I was like, nah, I don't know if I really want to be short right here, because like I was just telling you guys about the risks of Powell moving forward. I think that is a risk because the market is already repriced, is already in the process of repricing. That's why we had such an aggressive move in the dollar. That's why we had such an aggressive move in gold. And as I told our traders, and I think I told you guys over the week ahead video, all the easy money has been made over the course of the last 3 days. If you guys did not catch, and I don't want to make you feel bad if you didn't, but I'm going to point out something that is extremely true, is if you did not make your money on this move down in gold or the move up in the dollar over the last few days, the easy money has been made. Now it's going to be more challenging. Now it's going to be a little bit more difficult. You know, and I think it's, you know, this is going to be one of those weeks that is very transitory. Transitory. But yeah, hey, Greg is here, and let me just say this really quick. Stelios is out right now. He's in the UK. He took his family back to see his brother, his family, or some of his family, and he is today visiting with a bunch of the ForexAnalytix crew. Like I think Ryan and K-Man are out. I think they're all heading to the pub, and a few other people there from the ForexAnalytix community will be joining up with them, I believe, today. So that's really cool. Grega, it's, you know, Grega's popping in. Greg, I'm excited to hear what your views are. I was looking around at some of your Elliott wave views, and it still seems like that you are, you know, you've got some dollar bearishness going on. I was looking at your dollar index, you know, looks. What are your thoughts here with the dollar?
Well, I think that last week move after the ECB, actually it's clearly impulsive. I think that we have a very strong move that puts a top in place on the euro, means the dollar more probably has also bottomed. More importantly, we have seen Aussie, which has been quite strong, and despite this hawkish RBA, despite this bounce today, I mean, to me, it doesn't look really that strong. Okay, so I think that dollar has room for more upside, but as you said, there will be a challenging time maybe for the next week, or maybe till we get the CPI figures from the US on February 14th. So maybe until then we get some pullbacks, but I think that we are in the middle of this corrective stage that should take us on dollar a little bit higher. Meaning
you know, I agree with you. I don't disagree. I was actually long dollars overnight. You know, and I basically got out with some break-even positions. I mean, I was like down a few pips here and there. But I look at the euro, and the euro is at channel support.
Exactly. And
you guys can see this channel. Same with the Aussie channel support. Sterling, you know, we're back at basically 120, you know, but we're hitting like new lows, divergent relative strength. So
it's really hard for me to chase the dollar higher here. And based on the information that I just gave you guys, as far as rate expectations, what the market's pricing, and facing Powell today, you know. So anyway, those are just my thoughts. So
also,
what do you,
also we have a very nice impulsive decline on the euro dollar, and we know that after the 5-wave drop, I posted this chart, I believe, on our chat room as well. And after 5 waves down, we expect a 3-wave rally. So I think that the support here around 1.7 is a very strong one, and very important Powell speech could maybe define the next rally. But I think that the rally is opportunity for short. I think that 108 is the first resistance. That was the previous swing low back from January, actually.
Excuse me.
Yeah, and above that, we have 109. But since we have very pretty strong decline, I think that maybe 108 could be already the first.
So we could probably do something like this then, right?
Yeah, and then to the downside.
Yeah, and then see a bit of a reversal like that. Okay, you know, and I mean, look, 107 is really, really strong support here. I agree. It's at a 618 retracement. We're oversold. We're starting to hit new lows with relative strength, not hitting new lows. So I think to be short down here, you have to be really careful. I'll also point this out with the dollar index. I tweeted this yesterday, but I want to clarify what I tweeted here. We have if you look at the dollar from, this is October, right? No, I'm sorry. That's January to February. So that's the, you know, basically 30 days worth of a move. We hit a 618. Then the last leg lower, they hit a new low. We did 161% extension confluence right here. We're really at key resistance in the dollar index. It's a confluence of pretty critical fib levels. So I, you know, and I do think that the dollar is bullish, but you know, if we redraw a little bit, let me just take this here and look at the dollar index. This is the green line, right? You know, you redraw that a little bit and just, you know, are we really at you know, we're at channel resistance, right? So
if you think the dollar will make some pullback from here, what would be your choice? I mean, which pair would you look for?
You know, that's a good question. Probably just the euro. I mean, I don't really want to be aggressive in any dollar shorts right now, because I'm more of a dollar bull over the next couple of months. But I mean, if you take the euro, like, yeah, if we can get just an opportunity to sell the euro back at 108, somewhere up here, you know, 108 and a quarter. I mean, that's ultimately where I'd like to be on the short side of the euro again. You know, obviously I want to see what's happening too. I think this week is going to be more of a challenge because we do have, you know, we have Powell today, which everybody's just kind of, you know, reducing positions ahead of Powell. But the fact is we got inflation data next week. We got CPI next week, and that's going to be where the market hangs its hat on, I think, the data wise, right? And one of the other things, and I'd love to ask you guys this, especially you, Grega, you know, in the S&P is holding up pretty well. We had a false breakout last week, but the S&P is holding up well. The NASDAQ's holding up well. Earnings haven't been a complete disaster yet. And what do you think about the markets here? Like, well, the overall,
I'm not seeing the breakout here on the S&P yet. I just still think and still believe that we could see some very interesting drop. Even 3,800, in my opinion, is very possible, especially as we said, dollar has begun this corrective stage, probably will take us higher. Of course, there will be some pullbacks now and then, but overall, this corrective rally on dollar suggests that stocks are a little bit too high, potentially at the resistance. So as long as we are seeing dollar in recovery mode, I just think that stocks will have hard times breaking these levels. And that's why actually the S&P 500 is not confirming the breakout here.
All right.
So you have the VIX, known as a fear index, is testing the extreme of 2022. I know that we haven't seen any massive volatility here based on fear, but still, I think that now when we have no fear, that's when we have to be aware that maybe the opposite reaction can be very, very sharp one because they are not
That's
expected.
good to hear, Greg. On long June 25 calls.
Are you Dale? Why are you long calls?
Because the other products have erosion, I figured I'd go for the leverage, and figured I'd have enough time in June, and divergences down there in the VIX. And the same reason as Greg has said, you know, you have recency bias. People were buying the VIX a year and a half ago when we were still in a bull market. It didn't pay them while we were declining. And no, people are saying it's a waste of money to hedge volatility. So it's the ultimate contrarian trade.
Steve, what do you think here? What are your thoughts regarding equities? Are you a buyer of equities at these levels, or do you think they should be sold? I mean, we got this technical breakout in the S&P, you know, well above that channel.
I talked about it yesterday on the morning edge.
Yeah, but that's just for the people in the ForexAnalytix community. How about the people here?
Fundamentally, I don't see value being long. Technically, since we've broken out, I can't, possibly advocate to be short unless we slip back within the channel and this is left off as a false breakout. So at the moment, I wouldn't advocate either being long or short.
It's a neutral.
Yeah, it is, because technically it shows bullish. Fundamentally, I think there are huge dangers for stocks.
You have a count in the VIX, Greg?
You're no fun.
No, I don't have. You know, I usually don't do the wave count in VIX because it's moving in cycles. So I rather look from that kind of perspective.
Greg is right.
Is there a count, Greg, where we get a pullback here in S&Ps, and then we rally up towards Blake's line at 4,300 around the August high, and then if we decline from there, it could be considered an X wave, whatever that is?
Yeah, but then if that would be the case, then I believe that we will be stuck in some very complex corrective pattern. So I think that for now, buying the dips is still what I'm looking for. The S&P 500 is not that strong, but if someone is looking to buy the dips, maybe technology sector is much more attractive rather than looking at the S&P 500. So in my opinion,
semiconductors.
Yeah. So I think that NASDAQ 100 and all of those indexes could continue higher, but I just think that there will be some pullbacks first, not a straight move to new highs.
Okay.
All right. Well, Grego, let me ask you this, since we got about 7 minutes before Joseph Wang comes in. What's your best ideas for this week? Like, what are you thinking to do? You know, last week was such a big week in the market. Are you looking to do anything specifically with any particular product?
I'm waiting on rally on Euro and Aussie for potential shorts. That's one thing, but I'm not sure if we'll get a rally from here or even lower levels. So just have to be patient and wait. The next one is looking at the CAD yen. If you will open the CAD yen chart, you will see that we are approaching some interesting levels around 100. We are potentially now in wave C of a corrective rally from the lows. We have Bank of Canada who said that they are on pause. And then on the other hand, we have still ongoing inflation in Japan. And if that will continue, I think that that CAD yen could be actually a very interesting opportunity on the short side.
Okay, on the short side. Well, you know,
from 100 around there.
Yeah, I was gonna say, you know, right here around 99.50. It just, you know, that's a pretty big level of support. If we can get, you know, previous support should be current resistance somewhere around there. So I see what you're saying. How about you, Dale? Any big ideas today? It sounds like you're aggressively going with the VIX. So what are your thoughts here?
I'm waiting for buying opportunities also in the miners. I think that the GDX could pull back to 28 to 27, and I think it might be the last bus stop to get on board. So we'll see what happens with the metals. you know, I don't think this is the end of the bull market, and we should be looking for levels to buy.
All right.
Lower, but not
you
yet.
know, I'm sorry.
Lower.
Not yet.
Yeah.
Okay. You know, looking at gold, I know we were talking about this earlier. Here's the dollar index. We had this, you know, or sorry, the daily chart is what I meant to say. We had a bearish engulfing here in the gold market, and we've slipped, you know, back into this channel. We finally got your throw over after a month of not doing anything. But we're heading right into channel support here. And gold's, I mean, I have to admit, gold's holding up. Silver finally broke down like we assumed it would, right? Because it was underperforming. So we finally broke out of that range and we're moving lower, coming into some pretty critical support. But gold still looks pretty good. I mean, so where would you be a buyer of gold? I know you were talking about, you know, the miners, but is there a place that you like gold on the long side?
1820 to 1780.
Okay. All right. Somewhere, this is a big zone.
And maybe it happens on a bad inflation report, you know, and they sell off gold because that means more tightening. So it could happen next week.
All right. Well, there's a lot of room down there, so that'll be that'll be interesting to see. Well, we got just a couple of minutes. I'm going to give you guys just for me, what I'm looking for this week is, well, first of all, the euro is at support. And just keep in mind, this is really critical support. This is the 618 retracement, also channel support. And we've gone pretty far, pretty quick. If you look at, you know, the last move higher in the euro, right? The 161% extension comes just a little bit lower at 106.50. We could dip down there, but remember, we do have Powell today. Powell is at noon. I'm interested to hear what you know, Joseph Wang has to say about the Fed chair and how he's handled this situation over the course of the last year after his after the transitory transitory call. I think he's, like I said, I think he's done a really good job. I think the Fed has. The cable, you know, we're at the 78% retracement here. So the cable, remember, we have a long-term double top that is setting up, but the double top doesn't come really into play until you start breaking a neckline, which would be somewhere around here, and which we're getting close to in the cable. And we've talked a lot about that on the week ahead video. So if you caught the week ahead video from last week, we talked. This is one of the big chart developments that we're taking a look at. But keep an eye on, you know, some of these you know, commodity currencies. You do have the RBA that a lot of people were thinking that the RBA would be finishing with their rate hike campaigns. And after last night, the RBA, you know, basically said there could be more hikes ahead. And that's why the Aussie is outperforming right now. But we could be developing like an inverted head and shoulder pattern here too. So I think you got to keep an eye on the Aussie, especially while you're above, you know, let's just call it 68, 90, somewhere around here. We could dip a little bit further than where we're currently at, maybe another 15, 20 pips. But we are currently trying to develop an inverted head and shoulder pattern in the Aussie dollar. But that would be helped out by risk. And stocks are a little weaker right now, as you can see, but we're still holding about 4,000. If I could give you guys a quick view on the S&P, I think the S&P is really, and this is, you know, something we talked about on the morning edge yesterday, which is the ForexAnalytix community conversations. We have three levels that really you have to look at. You got 4,200, which is the recent highs, and remember that was a false breakout. You got the 4,100, which stopped us yesterday. And then you have 4,000, which is actually a 618 retracement, which would be the bottom of this range. Notice how we're in the middle of the range right now. We're in the middle of this range, in between two, like basically you got a one big figure one direction, one big figure the other direction, and we're stuck right in the middle. So if you think that the S&P is super, you know, has a lot of direction right now, it really doesn't. We're trapped between
being in a nice bullish trend higher and having a false breakout from last week. So we're stuck right in the middle between those two really key levels. So whether you're talking about 4,000, 4,200, that's kind of where the S&P extremities of the range are going to be. And right now we're just stuck right in the middle of it. So my 2 cents is we're going to probably be stuck here between now and the inflation data that comes out next week. But I know Dale's guest is here right now. I want to say thank you all for your continued support and being here each and every morning with us at the same time. Make sure you're with us tomorrow. Make sure you try out ForexAnalytix so you can jump in. You know, this is, I want to say, probably the most active community in the markets. I'll just show you. This is where I got up this morning, somewhere around here. And you can just see all the chatting over the last hour and a half that's been going on in our
lots of ideas.
Just the general chat room, Dale. That's just the general chat room. That's not even the trades room. It's not the macro chat room, the flowonomics room. Lots of ideas flowing around. Speaking of ideas, Joseph Wang is here, and I'm sure he's chock full of ideas ahead of Fed Chair Powell today. So, Dale, have a great interview.
All right.
Steve,
thank you, Blake.
My pleasure. Steve, Grega, thank you guys for being here.
Yeah, Greg, a nice call on the NFP last week, buddy. And Steve, it's so great to have you in F.A.C.E, and you sound
nice to be
strong.
back.
Sounding strong. All right. So Joseph, welcome back.
Oh, hey guys. Thanks for inviting me. It's a pleasure to be here. Can you hear me?
Yeah, great timing to have you today. Do you have any expectations about Jerome Powell's speech this afternoon?
Yeah, that's the question of today. Honestly, I don't know what he's going to do, and I'll tell you why. So usually what we expect in the past is that, so Jay Powell says something, the markets rally, and then Jay Powell gets mad, he comes back and he finds an opportunity to talk the markets down, right? That's been the pattern the past year. And, you know, I don't know if he's going to do that again. The reason I don't know is that back at the FOMC presser last week, he had the opportunity to talk the markets down. He was asked repeatedly what he thought about financial conditions. And Jay Powell, he knows what that means. He knows what to do, and he just kind of sidestepped it. In fact, he seemed pretty open to even modifying his expected rate path if data was softer than expected. So he seemed to not want to do that anymore. So now that he has this meeting scheduled, I'm not sure if he's going to talk down the markets, because it seems that his reaction function has changed. He's more comfortable with the path of inflation, so maybe he doesn't feel the need to talk down the market anymore.
Okay, I know Larry Lindsay was on CNBC, and he thought it was one of the worst Fed speeches he's ever heard, and that his demeanor, it was more about his demeanor, which you're talking about. You know, he was the good cop the other day. Yeah, so he goes between good cop and bad cop, and you know, but you think that he's gotten comfortable with what's going on in inflation. So I want to ask you, the market was, you know, kind of, you know, fighting it was described as fighting the Fed, but the employment report we had Friday led to a pretty nice technical breakout in 10-year yields. Do you believe that this has staying power, and that we could actually 10-year note could rally to above the 4% level into the end of the year?
I do. So this has more to do with my just general macro view that we are in a regime change where inflation is going to stay persistently higher than it was in the past. So I think the lows for the 10-year, the generational lows for the 10-year are in, and we are going to reverse that trend, downward trend from the past few decades, and we're going to gradually grind higher. So I do expect the 10-year to finish the year above 4%. So
don't you think the market's a little bit wrong-footed on that expectation?
I think the market,
I know it all changed Friday, but Aren't there a lot of people that are saying, well, there were anomalies in the NFP report and it'll be revised next month, and they're not? And I even heard a guy say, well, it was only 2 up days in yield. So a lot of people are trying to say it, you know, just a little trading blip, and there wasn't significance in what yields did in the last few days. Do you think that? Yeah, do you know what I mean? That people are
absolutely
downplaying the NFP?
So when I look at the markets, I see a very strong bias towards the view that you know, Fed is just going to cut rates, so we're going to go back to the old regime and so forth. And you can see that, like you said, people have been fighting the Fed all of last year too, and they've been losing, right? You know, old market adage, don't fight the Fed. So, and you know, sometimes the Fed is wrong, to be fair, but broadly speaking, though, don't fight the Fed on the way up, and I wouldn't fight the Fed on the way down either. So to the view of those people who are doubting the Fed, I think that when I look at the markets, I think that markets always think that the future looks like the past. And we can clearly see this when we transitioned out of the great financial crises. Before the great financial crises, our Fed would routinely hike rates around, let's say, 4 or 5%, and then cut a bit and so forth. So after the great financial crisis, if you look at the market, it was always pricing that the Fed would just go up to, you know, let's say 4% in a few years, right? That's what they were always thinking. And they were always wrong for many years. It wasn't until, of course, today that we actually went up to, you know, 4%. So those guys, they were wrong for almost a decade. But
it's like recency bias.
Exactly. And
go ahead.
So over the years, the market gradually adjusted that, you know, maybe we're not always going to go up to 4%. And the market now thinks that we're just always going towards zero because the Fed's just always going to cut rates all the time. So it thinks, like you mentioned, recency bias. It thinks the future looks like the past. And the past has been a world of low interest rates and a Fed that's eager to cut. But what I think the market doesn't realize is that inflation fundamentally changes the Fed's reaction function. And so that means we're not really going back to let's cut immediately to zero again. So it's a different world, and it's going to take time for the market to digest, but it's getting there.
Okay. Last time I talked to you was at our Trader Summit in October, Joseph, and, you know, people don't know how I could remember what people said months ago, but I want to congratulate you. You were talking about risk on in October, and that was a great call. That was an important bottom that you called. The other half of the equation was you thought the dollar would rally with the market, and the opposite happened. Now we're getting a bounce in the dollar. Has your view on the dollar changed with that big decline that we had, and this might just be a bounce in an otherwise bear market in the dollar?
I actually, so this huge bounce in this huge sell-off in the dollar the past couple months, I didn't expect that. And it seems to me it has to do with the bias of the market in rapidly pricing in rate cuts, thinking would go back to I guess pre-COVID framework.
Okay.
And when the market prices in rate cuts, you know, a lot of things happen. Risk assets rally as they've been rallying, and also the dollar sells off. Okay. Now, because I think that rates are going to be higher for longer, like Powell said, I think the dollar will strengthen from here. And actually, among all the asset classes that I trade, I'm most comfortable with long dollar right now. And I'll tell you why. Okay. So I'm most comfortable for long dollar because of how the financial system is structured across the world. So if you think about it, so a central bank hikes rates, not just the Fed, but any other central bank, and they expect that to go through the economy and slow everything down, right? But you have to think a little bit more as to how that works. So it works in a number of ways, and how it works depends on which country you are, because every country is different. In the US, say in Canada, in New Zealand, in the UK, a number of Euro countries, for example, one of the ways that works is that when they hike rates, it directly feeds into the mortgage rates of the households. So households there have either variable or have mortgages that renew in just, let's say, within 5 years. So the households are very, very, I guess, sensitive to interest rates. So you can just hike a little bit and immediately people feel the drag. They have to pay more on their mortgage payments. There's less demand and the economy slows. That's not the case in the US. In the US, our financial system is structured so that such that both businesses and people are very resilient to interest rates. If you look at households, we have 30-year fixed rate mortgages, right? So basically everyone is locked in around 3%.
Right.
You can raise rates a lot. It's not going to affect them. Their interest rates are low. For the corporate sector, a lot of people borrowed a ton during the pandemic, and they don't have to have, there's not that maturity wall of refinancing until I think another year or two. So so in the US, if they wanted to slow the economy down, they'd have to hike rates more than other countries. Other countries don't have to hike as much. And that short-term interest rate differential will become more apparent when inflation stays higher than longer. And so I think that's going to strengthen the dollar because the dollar will have to hike more than the other countries.
Okay, because a lot of people have been rationalizing their long euro, and I could tell one of my associates wants to talk to you. But one of the fundamental rationales was the interest rate differential, that Europe was going to remain tighter and more hawkish than the U.S., and you're saying that's not going to be the case.
Yeah, I don't think that they can. So if you look at it, so again, how monetary policy, so your hiking rates and its impact on the economy is going to depend upon how your financial system is structured. One interesting about Europe is that if you look across the European Union, some countries, let's say the Iberian countries, Spain, Portugal, for example, tend to have mortgages that are, I guess, more variable, and other
like
countries,
Canada
yes,
too.
like that, and other countries in Europe have fixed rate, let's say 20-year mortgages. I think that's how it is in France. So you have this additional political problem here, where when you hike rates, you really screw some countries, but other countries, you don't really do anything to them. So I think that makes it difficult for them to continue very aggressive rate hikes.
Okay. Joseph, sorry to interject, Steve here. I have a question, a follow-up question having to do, you just said that you feel comfortable being long the dollar. So my question there is, looking more for a rebound, or do you actually believe that the dollar can produce new highs within the months ahead?
I think it depends on the currency pair more. So I'm long the dollar.
Let's talk about the DXY, for example, which is the index, right?
So can you pull up a chart of the DXY? I don't. So I usually look at currency pairs rather than.
All right. So there was a high, Joseph, 14.5 back in September, late September. And then, if you're more comfortable making a comment about an individual pair, the euro makes up of the majority of the dollar index. So I guess Steve
I could see the euro going with the retesting one parity again is
parity.
How I retested. So I wouldn't actually, I feel comfortable thinking the euro would go below parity by the end of the year, and that's kind of how I position myself. So I mean, there's some geopolitical kicker in my view, and this is just aside from monetary policy. Monetary policy alone, I think, gets it to close to parity, but I think that there's significant geopolitical risk that's not being priced into the markets. Like
Russia doing better in Ukraine?
So when I think of the conflict between Russia and Ukraine, it looks very much like a proxy war of the West against Russia. And when I hear what the U.S. is doing, I think they want it. And if you want it, you're going to get it. So so that's how I look at this. So I would say this actually. So in 2020. I was looking at what was happening in China and the COVID and all that stuff. And I was really surprised that the market did not react to that here. And I was really positioned for that. but the market just went up every day. It's like they completely ignored this huge development in a really big part of the world. And I think something similar is happening here with the Russia-Ukraine conference, and that, guys, they're obviously fighting a proxy war with Russia. Everyone is sending Ukraine weapons, and they're sending more and more weapons. This can't end well. So you have some serious terror risk that this could escalate, and if it does, you have an immediate tremendous flight to the dollar, and the euro will suffer.
Okay, interesting. And what about the reopening with China? Does that play a role into possibly keeping the Fed tighter for longer, as you know, they were locked down, and that, you know, energy use is going to go up, everything's going to go up if they're successful with the reopening?
I don't know. So
Okay,
when I look at China, so there's you know, like you mentioned, when you reopen the economy, people, you know, do more economic activity, and there's more demand for certain things like commodities, although you haven't seen that in oil at all. And on the flip side, though, when people go back to work, they start working in factories and so forth, the supply of goods and services increases significantly. So you have a demand increase and also a supply increase. And how that works out, I think it's probably going to depend on an industry by industry basis. You know, maybe some industries were particularly constrained by shutdowns in China. Now they can get their goods and services again, and maybe others won't be as affected. So I think there's more nuance to that I'm not.
Do you see any geo risk with China? And you know, we're in at least a Cold War with them now. Just like you say, we want this war with Russia, the proxy war. Does China want war to be able to absorb Taiwan? And, you know, what do you think about the balloons popping up over? You know, it definitely wasn't a hot air balloon where you take a nice little ride. So you have any thoughts on that?
Yeah, I'm really surprised about that. I think that was a big nothing. So obviously, China is spying on the US, right? US is spying on China, China is spying on US. Same for any other country in the entire world. Why that deserved a tremendous amounts of news and so forth, I don't really know. So, you know, I don't know why the administration wanted to play that up.
Well, I've heard some people say, well, it shows that we can't control our own airspace and just let it float across the country. You know, that they may have been testing our reaction to what we would do.
For all I know, somebody got their budget cut and was upset and wanted to blow up that issue so that they would get more budget. So yeah, I really don't know why we focused, why the press focused on that.
Okay, has your view on risk changed since we've had this pretty dramatic rally? And really the January effect in my career, I've never seen a better January. Have you?
Well, you have a longer career than me, and so I take
don't
your word
rub
for
it in.
Hey, it's good. So you know, you have seen a lot, so people should listen to you. So I don't know. So when I look at equities, I'm not super clear. I don't have a strong conviction. I would be happy that I would, you know, actually not be surprised if we just muddle around this range I'd say between 4,100 and well, I guess the 3,600 lows of last year for the rest of the year.
All right. And anything else that you might want to wrap it with that you'd like to share with us? So higher yields, part of the structural thing. The employment picture, Joseph, maybe we could talk about that, wrap it with that. I mean, how do you resolve a labor shortage with higher rates? How do you get people to go back to work?
So it's hard to get people to go back to work, I think, for a couple of reasons. One is that, well, boomers just don't have to work anymore. I mean, think about all the people who bought homes for like, you know, $50,000, like when they were growing up. Now they're like 100,000, few $100,000, $1 million.
Yeah.
Same if people had invested a little bit in the stock market. It's went up a lot. So you blew this huge asset bubble over the few decades. And at the end of the day, there's just not a lot of need for a lot of the boomers to work. And so a lot of them have been retiring early. And so that's one thing. The second thing is that I think that we have shortages in certain areas, and that has to do with the fact that labor shortage, that has to do with sociology. We trained an entire generation of kids to go to college and blah 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 and something like that. But that's not really what we need today. We need people who do jobs in trades, who are more hands-on with their approach. And we're just kind of taught all these kids that that's not good. We shouldn't do that, even though, I'll say, for an average person, going to your local college and studying English, you're not going to get a job. But if you go and study welding or something like that, you can get a really good job and you can do really well. So I think we have this structural mismatch that's in part due to sociology. And the third thing is that we just have a workforce that's just not growing anymore.
The demographics.
We had small families back in the 70s and 80s, and so that's changing. So I think the labor market is going to stay tight for the next 10 years at least.
I'd like to just bring this up and get your thoughts on it. Recency bias that you've talked about. So we really never had any huge spikes in volatility. People were buying, hedging of volatility and buying puts all last year, and most didn't get paid, especially in VIX. So if you don't get paid with what the market did, 30% lower, there's people saying, well, now is not, it's a waste of money to hedge. That's kind of the way that people are looking. The VIX is broken. And with some of the things that you're talking about, as far as an expansion or more, spreading of this war in Ukraine, I would think that it might be a good spec to look at, maybe buying some call options on the VIX going forward. What do you think? Is volatility dead?
So like you mentioned, it does seem like, VIX, so puts haven't been working very well as a hedge, so people don't seem to be buying as much, and so that leads to less demand for volatility. So I own puts on the S&P. That's how I would get exposure to volatility rather than the VIX. Especially now, from my perspective, it seems like the S&P has had a run, and so it's kind of towards the top of the range that I would expect throughout the year. So you would get exposure to volatility and to delta on the S&P. So that's how I'm positioned.
Okay, and I just want to bring up your website here for people to. It looks like there's a change.
Yeah. Oh well, I have FedGuide.com. So FedGuide.com is where I would write my market commentary. I would check that out. So if you're interested in, so I do three things. I do on FedGuide.com. I write about recent market developments that you can check out. Most recently on Governor Waller's comments on having QT for longer. If you're interested in more basic principles about how the financial system works, I could recommend Central Banking 101. And if you'd like to have a basic introduction to macro asset classes, I have a course called Markets 101 as well.
Okay, so if you're looking for an expert when it comes to Fed speak and what they're doing, you just listened to one for the last 25 minutes, Joseph Wang. And I recommend that you try and get some clarity about the Fed, that Joseph's a go-to guy for that purpose.
Hey, Dale, I just really quick, I just want to jump in and say, Joseph, thanks for spending your time with us. It's always a pleasure to hear you on the F.A.C.E show, and when you're blessing us and our community with your knowledge. You're definitely one of the most knowledgeable figures out in the social media space on the Fed. So thank you for all your commentary.
My pleasure. Thanks so much, Dale and Blank. It's been a pleasure being on the show. And And I hope happy trading. Good luck to everyone.
Good hunting, my trading warrior brother.
Thank
All right,
you
Joseph,
too.
thank you so much. Joseph Wang, everybody. Hope you enjoyed it. I'll get in touch with you, Joseph, keep you in the rotation, and you could join the team in 20 minutes for the morning edge. Remember, don't just count your pips, count your blessings, and hope you enjoyed what we did here today, and I'll see everyone tomorrow. Good hunting. Adios.